Hello, this is Wanjiru Gishangi. How are you? How is your trading journey so far? I hope you found value in my other videos. Make sure that you watch them before you watch this one because we agreed that we'll be doing them systematically, so they will be in series form. And about reversal patterns. What are institutional reversal patterns? These are patterns that show when the market makers are about to shift their investment. This is when they change the market from a buying cycle to a selling cycle. So that is what we will be talking about in this recording. But before we get there, before we get to the reversal patterns, let's talk about the trend. If you're a beginner, or you've just started trading, or this is your first interaction with this channel, it's important that you always know how to find your trend. Now, when we talk about the trends, this is basically the market direction. This is the same as the cycle, the same as the buyers or the order flow. All those five names, they basically mean the same thing. They're only different based on the strategy that is being discussed. Now, today we're not talking about any specific strategy. We're just talking about the market and how it changes direction. So for the trend, if you want to know the trend of the market, you can use any time frame that is above the 1 hour. So you can use the 1 hour, the 4 hour, the daily, the weekly, or the monthly chart. Now, the time frame will be dictated by the kind of trader that you are. If you're a day trader or a sessional trader, this is a trader who gets in a trade today and actually closes that trade within the same day. Then you can use the 1 hour or the 4 hour chart. If you're a swing trader is a trader who holds a trade for more than a day, then you can use either the 4 hour, the daily, the weekly, and the monthly. It all depends with how long you want to hold your trade. Be very careful not to try getting the trend on the lower time frame because the lower time frame will not give you the true picture in the market. So basically in this video, we'll be using the 4 hour chart and the 1 hour chart to spot our trend reversals. First, let's talk about the three market trends. Now, there are three market trends. We can call them the trends or the cycles. Note when you open your chart on this other end, this is where you find the prices given by the broker. So trend number one or cycle number one, when the market is coming from a low price, so you have this low price, you can check the price point here, and it's pushing upward to another higher price point here, we say that the market is pushing upward. This upward movement is what we call the buying cycle. So the easiest way to know if you're on a buying cycle is to check your price point. See if the market is coming from a low price heading up to a higher price. Trend number two or cycle number two, when the market is coming from a higher price and it's pushing downward to a lower price. Now, this is the current price as I record this recording. You can see the market is live and moving. So when the market is coming from a higher price to a lower price, we say that the market is moving downward. This downward movement is what we call the selling cycle. At some point, the market may not move up or down. It may decide to be at a price point. Now, with this price point, this is what we call the sideways movement. This sideways movement is better known as the ranging trend or the ranging cycle. So those are the three trends or cycles in the market. Now, the cycles are supposed to help you to know how to approach your tradable item. What do I mean by that? If you're on a buying cycle, then you should be disciplined enough to only look for buying opportunities. This is until you've really spent time with the tradable items of your choice, and now you have the confidence to counter trade. Before you get to that level, it's always good to trade with the trend. Make the trend your friend, meaning if you're on the buying cycle, only look for buying opportunities. If you're on the selling cycle, yours is to look for selling opportunities. Be disciplined enough to sit on those hands, not to be tempted to counter trade, or rather to take these buys on a selling cycle. And of course, anytime you encounter a ranging trend or a ranging cycle, it's good that you keep off. Why do we keep off from a ranging market? Because the ranging market only appears when a tradable item does not have institutional sponsorship. If the institutions are not investing in a certain item, then you have no business in it. So if the currency is on a range, don't get yourself trapped. Just keep off, sit on those hands and just basically watch until you get a trend. So as you're growing your accounts, it's important that you only do trades that are within either the buying cycle or the selling cycle. Later on, as you master your trading and you've mastered your items, now you can do some scalping here if that interests you. But to be on the safe side, it's important that you do the trending market. So basically, those are the three cycles that are present in the market. Note that is what you do every time you open your charts. The first thing you want to do is to note the cycle that you're on so that the cycle will guide you to know what kind of trades you should be taking. The next step now, after knowing your trend, is to check for entries. Now, entries, you'll be working with your trading strategy, whichever trading strategy that you're using. Now you get to a lower time frame and find your entry. If you're yet to learn about the trading strategies, you can pick any strategy from any of my 4 ebooks, or you can actually get the mentorship for entry rules and exit. So let's go ahead to the universal or reversal, sorry, the institutional reversal patterns. Now, there are 4 of them. We have 4 of them. So we have the 4. Here we have 1. There's the 3 or 4 hits. We have 3 or 4 hits to the low or high. This usually forms the peak formation low or peak formation high. Now, if you're market maker trader, that is if you're BTMM trader, then you're already familiar with the PFL and PFH. If you're a technical trader, of course, you know about your lows and your highs. And if this is the first interaction you're getting with the market, then you're just going to flow with the video and see what I mean. So when you talk about 3 hits to the low or 3 hits to the high, you'd be expecting something like this. 1, 2, 3, then shift. So you have this 1 low, 2 low, the 3rd low, and the 3rd low will give you break of market structure. These are the 3 hits to the low. Okay, so they create the peak formation low, and once the peak formation low is created, then there's break of market structure. This is what so many people call neckline. So the neckline will be broken, what we call the break of market structure. If you're dealing with the hits to the top, so you have 1 high, a 2nd high, a 3rd high, then the market just shifts. So you have the first high or higher high, the 2nd higher high, the 3rd higher high, and with the 3rd higher high, this break of market structure. Now, to continue with this trend, if you're looking for a buy trade, it's important that you do not get into the trade at this point. Why? Because the market is expected to retrace back to a rejection zone below here before continuing up. Okay, very important. Do not think that the market is rushing. Don't chase that trend. It's just forming. So don't chase it. Don't get into a trade here. Okay, don't get into a trade here. Wait for the market to give you what we call the discounted entry. And this discounted entry can either be on a block here, a rejection zone, or even down here, or it can just do a liquidity grab down here. So there's no point of getting to the trade at this point. So wait for the market to give you a discounted entry, then you can do a buy trade. For the sell trade, again, you expect the market to retrace. Note, it can do a liquidity grab up here. So it can be higher than this. Can also get to this point where maybe you have a rejection zone, and then from there, you're safe to sell. So do not sell again. Don't sell at this point. Okay, don't sell at this point. Don't be in a hurry to chase. Okay, when the break of market structure happens, the market has to retest the zone. Okay, if you're an institutional trader, we say it can retest the source with a liquidity grab, or it can retest the breaker or even a rejection zone. Okay, so don't just get in here. Please don't take a trade at this point or at this point. Wait for the market to give you a discounted entry. And once that happens, now you know that you're no longer, if this was, this is the 3 hits to the low and can also be a fourth hit. So there could be a fourth low here or a fourth high here. How do you tell? I know the question would be, how do you tell that there will be 3 or there will be 4? Okay, how will you tell? If this market that breaks structure, is not impassive, what I mean is this, when the third low is hit, this move should be very fast, very huge candles. Okay, very huge candles should break structure. But if you find that on the third hit, the market is just very, very slow, okay, very, very slow, it's not moving in an impassive move, then you should expect the fourth hit. Okay, the same way here. If the market, the one that breaks structure or after the third hit, the market is not impassive and it moves in a very slow manner, now you expect a fourth hit. I hope that is clear. Okay, how you tell whether there will be the fourth hit or the third hit depends with the volumes. When there's a lot of volume being pumped in the market, the move will be very fast, very huge candlestick. Can also be an economic event. Okay, there'll be what you call fundamentals or news. If that happens and gives you this move, then you know there's no fourth hit. But if it's just ranging or the market is accumulating while it tries to break this structure, then you know that there will be another move. So that is how to tell the 3 hits. Okay, the 3 hits and the 4 hits to the low or to the high. I hope I'm clear on that. So let's move to the second one, where we talk about a double-sided impassive move. Now, double-sided impassive move is where you have very heavy volumes pushing on both sides. This is what BTMM calls V. The V and the inverted, the V and the A's, okay, can be A inverted, V inverted, however, but this is what you get mostly when there's a lot of volumes from both sides and the market just have exhausted that zone and they want to shift the market very, very fast. So how does this work? So you be coming from a low ascending cycle, then all of a sudden there'll be this huge move to the bottom side and another very huge move or very high volume move to the high point, breaking structure. Okay, this is what we call the double-sided, meaning these huge volumes on this side and huge volumes on the other side, and on the buy side, they break structure. If you're from a buying cycle, so the market to move moving upward, then all of a sudden there's a spike to the top, a very huge spike to the top, and another one to the bottom side, and the one that goes to the bottom side breaks structure. Now, these moves here, they are characterized by very, very huge candlesticks. Okay, I mean very huge candlesticks. So if they are not huge and you find that there's a lot of accumulation or small candlestick, then that does not qualify as a double-sided impassive move. But the impassive move are very huge candlesticks moving on both sides. Once you see this kind, what you expect is the market to retrace back a little, maybe to check where this high move came from. So it will retrace to this point, then the market will continue. Okay, to also retrace to where this impassive move came from and broke down. So again, don't sell at the top of the impulsive move if you're on the sell side, and don't sell at this point if you're on the buy side. Okay, so don't sell at this point, don't buy at this point. Wait for the market to retrace. After every impulsive move, of course, there will be what we call the market to take a breather, if there's anything like that. So always have the patience. Remember, forex is a patience kind of field where you have to be really patient. When a move happens, wait for a discounted entry. Why are discounted entries even a thing that you should be waiting for? Because not all institutions will invest at the same time. So what they do, if they're huge, or what do we call them? Let's call them class A. If the class A kind of institutions invest in the market in a certain direction, they need to give their partners a discount entry to also join the wave. So what will happen? They will lower the prices to some point so that the class B can also join and ride in. So this is the best point for you to join the move. So that is it on the double-sided. Of course, I'll show you chart examples on MT4. So this, I'm just explaining it, and then we will deal with it as we find it on charts. Then we have the confirmed market structure. Now, confirmed market structure. In the last video, we talked about market structure. Market structure is basically where if you're on a buying cycle, the market is giving you higher highs and higher lows. If you're on the selling cycle, the market is giving you lower lows and lower highs. So that is basically what we call market structure. Now, when we talk about confirmed, the market is only confirmed, or the market structure is confirmed once you either have two higher highs or two lower lows. That is very, very important. Please be on the lookout for that and be very keen on this point. Market structure is only confirmed if you either have two highs or two lower lows, two higher highs or two lower lows. What am I saying? If you're on a selling cycle, you first get your first lower low, the market gives you a lower high, gives you a second lower low, then gives you another lower high, then pushes down. So we have the first lower low here. So this will be our lower high. This is basically market structure. We talked about it on the other video. Then we have lower low. So if you want to know if the trend is actually confirmed that the market structure is downward, you have to wait for the market to give you your second lower low. So you don't join this market, especially if you're just beginning, especially if you have a small account that you want to grow with little drawdowns, okay? You want to take trades that are really, really sure. Do not get into this market. Do not be in a hurry. Sit on those hands. Do not be in a hurry. Don't get into this trade if the market is just reversing without waiting for it to be confirmed or waiting for market structure to be confirmed. So after this second lower low, you're going to wait for the market to give you this lower high. And it is at this point that you will get into the sell trade. So this is the point where you will sell. Okay. This is the point at which you will sell. Meaning you will not sell with this first lower high. No, you will sell with the second one, and the second one only happens after you've gotten your two lower lows. Remember, it is the lower lows that are confirming structure. It's the second lower low that is confirming structure. So when the market pushes back to give you a lower high, that is when you prepare to sell. Now, the question you're going to ask is, how will you tell that now the lower highs have is complete or has formed? What do you do when the market is coming back? You expect it to come in an accumulative manner, not impulsive, okay? It will not move like very fast. No, it's going to create it using very small candlesticks, okay, or in an accumulative manner, and it will be coming back to a rejection zone. So when this lower high was created, there must have been a block, a block here that gave this shift. Remember, the lower lows will be created by an impulse move, very huge candlesticks creating this. But where did the huge movement come from? It came from a block here, right? Whichever block gave you this lower low is where the market is expected to retest that block. This block is usually called a rejection zone. We'll talk about rejection zones either on the Facebook page, or I'll create a video on that. But this market is expected to retest a rejection zone. And once that's done, it will create a lower high. And then from there, you're safe to sell. This is actually usually the highest or the heaviest, okay? The heaviest one creating the third lower low. And therefore, now you can continue riding until you create a peak formation low and look for a market reversal pattern. Sorry. Create a market reversal pattern. Sorry. So you expect it to go to the low, okay, create a market reversal pattern, this, and then start buying. Now, suppose you're on the buying cycle. So on the buying cycle, you expect the market to create the first high, come back, give you a higher low, create the second higher high, then give you another higher low. So this is the first higher high. When you get a higher high, what do you get? You get a higher low on this other side. And this is the second higher high. Now, once you get the second higher high, it means that the market structure has been confirmed. Okay, let me delete this. Once you get the second high, it means that the market structure has been confirmed, meaning now we are on a buying cycle. So what will you be looking for? You'll be looking for the market to give you a second higher low, and then from there, you can take the buy. So this will be the second higher low. Now, to be very, very clear, it is not the higher low that creates the market structure or confirms the market structure. It is the two higher highs, okay? So once you have the second higher high, now you know that the structure or the trend now is moving upward. So what do? You wait for this higher low to retest a block, whichever block that gave you this high. You can wait for it to retest, can be a rejection zone. And then from there, now from this point here, it is safe for you to buy. Now, this is the best way to take your trades. Why? Because one, you'll be taking trades that are sure. Okay, I know there's nothing like sure in this market because of economic events, but still you'll be taking trades that are institutionally positioned. Plus, these are not trades that will give you so much drawdown unless you get into early. Why? Because they are at institutional points. So basically, that is how you used confirmed market structure. Now let's move on to the simple market structure. I hope that point is clear. Where I've just said that the market structure is confirmed by either having two highs or two higher highs, sorry, and two lower lows. So about the market, the simple market structure. Now, the simple market structure will work like this. If you're on a selling cycle, you get lower lows, and then you get the peak, the break of market structure, and the market break of market structure. So this is called simple market structure. You're not waiting. Now here you have your first high, right? Because now we have broken structure. So we have our first high here. we have broken structure. Since these were lower lows, we've broken structure. Now we're pushing upward. For simple market structure, you will not wait for the second high to occur for you to know that the structure is confirmed. No, for simple market structure, now you wait for this high to create a lower high. This is where you wait for the market to either retest the block that gave you this high or do a liquidity grab down here, or maybe retest a rejection zone here. So can be a rejection zone, can be a fair value gap here that push there, or can also be a liquidity grab down here. So with simple market structure, sorry. So with simple market structure, I don't know why I'm doing all these write-ups. So let me repeat what I've just said. For simple market structure, all you require is the first higher high. I hope that is clear. All you require is the first higher high. Once you have the first higher high, you'll be expecting now the market to either retest the fair value gap or the imbalance on this impulsive. Remember, this is an impulsive move. Remember what I said, what an impulsive move is a very huge move with very huge candlesticks. So it will either retrace back to retest an imbalance. There was a post on the Facebook page that was explaining imbalance. So I hope you've read it and of course back tested it. So it will be retesting either an imbalance here, a fair value gap or imbalance or liquidity void. It will either also be coming back to a rejection zone down here, or it will be doing a liquidity grab, okay, meaning it will draw tails below this low. And once it does that, so there is that option one. There is also option two, where it does the liquidity. There is also where it comes back to that block, okay? So there's one, comes back to an imbalance, two goes back to a rejection zone or gives you the liquidity grab. And then from there, now you're safe to buy, okay? So this is market structure where you only use the first high. Now, suppose you're on the sell, you're expecting to sell, so you'll be having higher highs, then all of a sudden break of market structure. So we've broken that market structure, meaning we have this part here as the first lower low. Now with this lower low, you'd expect the market to retrace back either one to this imbalance here. There could be an imbalance or liquidity void. There could be a rejection zone here, or can also do a grab where it does throw tails here, okay, above this point. So you'd expect the market to either retest that imbalance, drop, or two, retest the rejection zone, drop, or throw the liquidity grab, drop. Okay, so this is not really clear, but I hope you understand. Otherwise, you see it on the chart. But basically, that is the market structure. Now, what I want to be very, very clear on is the difference between confirmed market structure and simple market structure is very, very simple. With the confirmed market structure, you're waiting for two higher highs or two lower lows. But for simple market structure, you're only dealing with one. Okay, you only wait for the market to break structure, give you either a higher high or a lower low. After retesting, now you're free to join. Now, the simple market structure is really not stable. It's not a reversal pattern that I would advise beginners to use, okay? Because at times you may find that the break of market structure was just a liquidity grab, okay? And you may end up losing a lot of money. So if you can avoid the simple market structure, unless you're very, very, very disciplined and you've really back tested it, then it's something that you can actually ignore. Now let's go to the charts. Let's go to the charts and see the different reversal patterns and how to find them on your chart. Now we have the first one, which is the three hits to the high. So this is GBP and ZD for our chart. We see this high. So what will you be looking for here? Let me mark it for you. So when you're talking about 3 hits to the high, you'll be looking for 3 highs to the top or 3 hits. So you have 1. Let me change the color. So you have the first one here. So you have the first high, we have the second high, and we have the third high. So these are the 3 hits to the high pattern. And after the third high, you can see that there is break of market structure. Remember, there has to be a break of your neckline for the trend reversal to be confirmed. So there's break of market structure. From there, we have a retracement back, creating our first lower high, and the market just continues down. So that is how to spot the 3 hits to the high. There will be 3 highs to the top. Note the third high will always be the heaviest. Okay, so this is how you tell that there will be only 3 hits and not 4 hits. Why? Because the final one will be really heavy. Look at these previous 2. They are not as heavy as this. And if it's characterized by 3 candlesticks, there's a video I talked about the power of 3. If it's 3 candlesticks to the high that are this huge, now that's a very, very good signal, because it tells you that's the hit and that's the final one. So to the high, you'd be looking for 3 candlesticks. Now that is not cast on stone. That is not a rule cast on stone. So don't just say if there are 3, then if they are not 3, then it's not a high. No, it's just added advantage if you can spot the 3 candlesticks to the high. Let's check on another currency. So we have this one here. Oh, sorry. Then we have 3 hits to the low. We have the 3 hits to the low. So we have 1 low, or the first lower low. We have the second lower low. Then we have the third lower low. Now look at the move to the downside, or the last low, or the last hit. It's quite heavy compared to the others, okay? And actually you can just say, you can even say therefore, if you so wish, but look at the other hits. They are not as heavy as the last one. So this is how you know that the market is really exhausting that point, because the third hit or the fourth hit will be quite heavy. And once the hit happens, you see now the market has broken structure. Remember, you should watch the previous video where I really marked these points on market structure. So this is a lower low, a lower low, a lower low. So this is a lower high, and this is a lower low. Then once the structure is broken, now we have a higher high. We expect the market to retrace and then keep pushing upward. So on market structure, there's no need of me repeating all that markup. You can watch the market structure video just to see. Today, I just want to highlight the patterns, okay, the reversal patterns. And you can see I'm using either the 1 hour chart or the 4 hour chart. So I hope that is clear. So let's move to another chart. Here we have the 3 hits to the low again. So this is a bit obvious now. You can see we have the first, the second, the third. And again, I cannot emphasize more, just to say the third hit will always be the heaviest, okay? The third hit will always be the heaviest. And once that hit is gone, there is break of market structure, okay? There is break of market structure. With a break, you expect the market to give you a discounted entry, and the market pushes higher. Let's move on. Now we have 3 hits to the high again. So we have the first high, higher high, the second higher high, and the third higher high. I hope you can see that. I hope I don't need to keep drawing them for you. I hope you can really see them. So we have those 3 highs, 1, 2, 3, and of course the third one is seriously heavy. From there, we have the break of market structure where our neckline is broken. From there, we have the lower low retest and the market pushes downward. So those are the 3 hits to the high and the 3 hits to the low. Another 3 hits to the low. Again, 1, 1, 2, 3, down, break of market structure, move up. So those are very easy. The 3 hits are very, very easy. Now let's talk about the double-sided impassive move pattern. Remember, the double-sided is where we say that the market will move very heavy on one direction and very heavy to the opposite direction. So look at this. This is Australian JPY. It's usually not a very heavy currency, but you can see the pattern. Moved heavy to the bottom side, created this point, then heavy to the opposite side, breaking market structure. There's the break of market structure. What happens after break of market structure? There's a discounted entry. You see, this is an imbalance. So the market will retest the imbalance. What is an imbalance? This is where there's only one participant in the market. So it will give you a huge candlestick. If it's buying candlestick, it means only the buyers are there. Meaning, because this market, let me first explain something keenly. This market has 2 equal partners or equal players. These are buyers and sellers. In the event that only one player is available or is trading at that particular point, that is when we say there is an imbalance. And how will you see it on your chart? There will be one very huge candlestick that is only that doesn't have other candlesticks or tails within it. For example, here you see this is a green candlestick, meaning only buyers were available in the market. So there's an imbalance. So when there's market structure, you expect the market to come back to retest that imbalance. This is usually called the liquidity void, okay, or imbalance or the fair value gap. All those names mean the same thing. We will actually do a video on that at some point. So there's retest of that and the market just goes higher. Anytime there's an imbalance, you expect the market to retest and push higher. So those are the double-sided impassive move. There's a huge move to this side, another huge on this side, breaking market structure. Then we have double-sided impassive move depending with the currency. Now see the difference between a pound pair and the Aussie pair. You see, that's different. For the Aussie is a bit slower, but when it's as heavy, it's coming from a pound pair, you can see it's quite heavy. So we have a sharp move down, a sharp move up, breaking market structure. The market retests the imbalance or the liquidity void, then pushes higher. So basically, this is a very, very good example of a double-sided impassive move pattern. So anytime you spot these patterns, remember, they are reversal patterns, okay? They are institutional reversal patterns. So this is how to know that the market makers are really shifting gear from being buyers to sellers or from sellers to buyers and vice versa. Let's check on another one. We have the double-sided impassive move now coming from the top side. So we've been buying, then we have an abrupt move to the top and another to the bottom side, breaking structure. Now, I don't know how much I'm supposed to emphasize, but the very important part of these reversal patterns is the break of market structure. If there is no break of market structure, that means that we really are not changing direction, or the market players or the institutions or the market makers are really not changing direction. So always make sure that we have a break of market structure. And what happens from there? All this is liquidity void. You can see only sellers were here. So the market is expected to give a discounted entry, then push down. Now, remember when I told you that it's not right for you to sell at this point, to chase the trade at this point and start selling, to sit on those hands and wait for the market to give you a discounted entry. This is the reason. Because if you get into a sell here, then the market retraces, you're going to lose money. Maybe your account cannot hold this depending with the lot size that you're using. So it's important after break of market structure, wait for the market to give you discounted entry, and then you can join the institutions. Then we have what we call the confirmed market structure pattern. Remember, I had explained the confirmed market structure is where you wait for either two higher highs if you're on a buying cycle or two lower lows if you're on a selling cycle. So here we have a high that was created. Then we have break of market structure from this point here. So we have break of market structure. So this market structure has been broken. Once it has been broken, it means that it has created our first lower low. So we have our lower low here. Now we have this lower low. So what does the market do? Now it retests. Okay, it goes back to this liquidity void, retest this, giving us a lower high. So from the highs, now we have an official lower high, then breaks down, comes below this first lower low, giving us our second lower low. So we have the second lower low here. After this lower low, now it means that our market structure has been confirmed. When we say that market structure has been confirmed, it means now we are off for the sell trade, okay? We are off for the selling cycle. So what will we be looking for? We'll be looking to sell. But at what point do we sell? We have to wait for the market to give us our second lower low. And what did we say about the second lower high? Sorry, lower high. It will be retesting a block or a rejection zone on this end. And you can see when this lower high happened, there's this liquidity void on this huge candlestick here. So when the market is retesting, we expect it to retest this block. So if I'm to draw this, you have that void there. So if we need to know where our second lower high will be, it will be retesting this liquidity void, or what we call the market imbalance. And once we get this lower high, now it's safe for us to sell. Now, this is what I was saying. When you're taking the confirmed market structure, you're really, really sure that you're taking the trade at the heaviest point. Allow me to delete this block. Look at the trade that you get into. It's actually heavier than the previous trades. That is why it's always good if you could master the confirmed market structure, because it will give you the heaviest trade in any cycle. But again, it's you to choose which among the four reversal patterns works well with your patience, okay? Your personality, your patience, and your trading discipline. But if you can master this, it usually gives you very, very good returns. So where you don't trade all this, you just wait for the market to be confirmed, for the structure to be confirmed, where it gives you your two lower lows. Then wait for the market to retest either a rejection zone, okay, or a selling block, or an imbalance or liquidity void, and then you're ready to do the trade. Okay, let me not overemphasize on that. Let's move on to another confirmed market structure. So here we have a high, we have a lower low, because this structure was broken at this point. So we have the first lower low. Going back, it's retesting this block here, giving us the first lower high. Breaks down to give us the second lower low, and then from there we are safe to sell. So that's the same thing that I have really spent time discussing on the other side. Then we have the confirmed market structure on the buy side. So here we have a lower low. We wait for the market to break structure, which is very, very important. Remember, very, very important for break of market structure. So we have the market structure being broken here. We wait for the market to retest, giving us our first high. So we have the first high, we have the second higher high. Once it gives us the second lower high, now it's all buy to the end. Okay. One thing that I feel the need to explain or the need to really emphasize is if you're going to use confirmed market structure, then have the discipline not to get trapped counter trading. Don't get yourself trapped counter trading. Okay, be patient enough. If you're a swing trader, the confirmed market structure will really work well with you, because all you have to do is really flex your muscles on those lot sizes, cover for the days that you've been waiting. For example, this break of structure happened on 5th of April. You just have to sit on those hands until the 15th of April. Those are 10 days of not trading this specific currency. Then do some lot size that will cover all those 10 days and enjoy for the whole month. Okay, that's the good thing with swing trading, that you just have to wait for the best entry, draw a lot size, forget about it. At the end of the month, take your profit, or at the end of the week, depending with how patient you are, get your money and get out. Let's talk about now the simple market structure. Remember, we say that the difference between confirmed market structure and simple market structure is, for the simple market structure, you do not wait to have the two higher highs or the two lower lows. You just pick one. And when the market retests the previous rejection zone, then you're good to go. So for this example, you see we were pushing down, then we go to this peak low. So we'd wait for market to break the neckline or break of market structure, which has happened with this green candlestick. My line is perfect. You can see that these two green candlestick broke our structure. Now we have this imbalance here. Look at this huge green candlestick. So we would expect the market to retest. So it can either retest the imbalance or liquidity void, or retest this block where the void came from. Okay, so here it retested the block actually, and then from there you save to buy and forget about it. Okay, so that is when you're just using simple market structure. You wait for the low or the high to be hit. Okay, wait for market to change, break market structure. Okay, break market structure, which would mean that we are reversing, then retest of a block or retest of a void or liquidity void, fair value gap or imbalance, and then get into the trade and move. Let's see another example of simple market structure. So here we've been pushing up, and you can actually use 2 or 3 reversal patterns at the same time. For example, look at this. This is a 3 hits to the high. These are 3 hits to the high, meaning the market will eventually sell. But you can also use it at market structure, simple market structure. Why? Because you can just say that low broke our lower low. Okay, there's this the void here, so we would expect the market to retest it. Okay, can be retesting the void or can be retesting this block here. So once it retests, you get into a sell. This was on 2nd of April. Hold it to 28th May, and that's it. Okay, so it's okay if you find 2 reversal patterns on one chart. It's actually very okay. Or you can just pick which one is your tea or is your cup of tea. Okay, so you can either use simple market structure, or you can use the others. All right, so basically that is how you use, or that is how you check if the market is truly reversing. And those are the four reversal patterns that if you see them, you're really sure. Okay, there's nothing like 100% sure in this market, but you'll be 99.9 sure that the market is about to reverse, because these are not common patterns that you find as continuation. Yeah, I know when there's the retest, when we're doing the away from peak kind of situation, you're going to see the 3 hits to the high, but it's not as common. Okay, it's not as common. So we can just say, if you spot them now, prepare to be on the lookout for for a reversal. So that is it. This has been an amazing time. So this is what I wanted to share on this session recording. Now, if you want to learn more about this, if you want insights here and there, you can always find me on my Forex page on Facebook. This is Forex Exploits Online Academy on Facebook, and it also has a group, the Forex Exploits group on Facebook. That is the easiest way to connect with me. Okay, instead of leaving comments on the YouTube channel, you can actually go to the Forex online Forex Exploits Online Academy page and inbox me there so that we can really interact. I would also want to know what topics you really want me to cover that will help you to grow in your trading journey. Otherwise, I'm Wanjiru Gishangi. I'm really, really grateful for being part of your trading journey. May you grow with us, and may we find this connection to really, really add value into your trading journey. Thank you so much from me, Wanjiro Gishangi. Until the next session, do not forget to follow, like, subscribe to this channel, share with your friends, and let's make Forex trading a professional business just like what it is supposed to be. So Forex trading is a business like any other. Always approach it professionally. Don't forget, it is doable. So until next time, thank you and do have a lovely time.